that will now take a look into investment. We know investment is one of the key pillars to success for any startup. And we're now going to have a conversation with the right moderator also for this topic. Red Power. He's got a great name and he's got a lot of experience as an editor at Forbes, a thought leader in leadership and scaling businesses. And you can also join Red here tomorrow on the 10X stage at 4:30, where he will launch his first, not his first book, his new book, actually, which is called Header Mantles. And you can even get a free copy here and learn about how self-talk impacts leadership and also the team. You'll find that tomorrow. But for now, let's focus on this conversation where we'll have Dr. Jörg Goschin, the CEO of KfW Capital. KfW is one of the largest LPs in the asset class European venture. They are a startup themselves, founded in 2018 upon the request of the German government. And now let's find out what are their insights. Please welcome with me Red Power and Dr. Jörg Goschin. Welcome.
Hello.
Works.
All right. Thank you for joining us this afternoon. We have an amazing conversation about driving venture capital growth and innovation with sovereign wealth funds. I've got to ask, there's a widespread concern about late-stage funding, the desert. And why does this gap persist? And even markets flush with liquidity, and what structural barriers are keeping sovereign and institutional investors from stepping into that more boldly?
Well, Red, thanks for it's a great question, actually. What does late-stage funding desert mean? I think we have to take a look back a decade ago, 10 years ago. Late-stage funding means funding a Series C or funding a Series D round. And getting capital for that was a challenge, but it was possible. Nowadays, late-stage funding means really to fund companies which are much further advanced, have much larger needs of capital, and the IPO is even further away than a decade ago. So in the effect, it's a much riskier, much less liquid investment from the sources of capital perspective, from the investor's perspective, and this is really something which needs to be addressed. And there are a couple of ways to address it, but if we now take the investor perspective to fund such a late-stage venture or tech company, you really have the challenge of the denominator effect. The denominator effect means, there was a crunch of the tech valuations in 2022, 2023, so where you had multiples, ARR multiples of 15 to 20, coming down to 6, 7, but surely below 10. And you have much less liquidity. So as an investor, an institutional investor, you have to have the challenge to balance the question, do you really want to invest into an illiquid asset, which at a multiple of 15 to 20 ARR, versus going into the public markets where you have much less valuations. So it really means there needs to be an adjustment of the valuations of the later stage companies. Of course, the founders want to avoid the dilution, but I think it's a necessity.
With the chaos going on in the U.S. right now, does this open any opportunities for Europe?
Sorry, I didn't get the question acoustically.
With the chaos going on in the U.S. right now, does that open any opportunities for Europe to take advantage of that?
Oh yeah, I think if we look at Europe, we also have a couple of challenges we are facing in Europe, but certainly, in order to further build the European venture capital ecosystem, we need to create a virtuous cycle of capital on the one side and talent on the other side. So this is a very important prerequisite. And you mentioned what's going on in the US. yes, I see there's already some brain drain of US talent coming or looking for new homes. And certainly Europe is one area which could benefit from that, but there are also other areas in the world, like the Gulf region, for example, which could benefit from that. Also, if you look at the situation of the tech, which is and the research and development, the capital which is available in Europe, we still fund research and development. If you read the latest news, I mean, Donald Trump has kind of cutting the budget of all the research and development organizations and the universities. So this is certainly a challenge for talent who want to work at the forefront of innovation.
Right. I think that's so true. I wanted to ask, a lot of Europe's most promising startups go to the U.S. They go to the U.S. Because of growth capital. What can sovereign funds do, and how can sovereign funds play a role in keeping people back in Europe?
The acoustics is really bad here.
So how can sovereign funds help keep the talent in Europe? Startups that are going for growth capital in the U.S. now, how can sovereign funds play a role in keeping them in Europe?
Yeah, got you. I think it's not only sovereign funds. I think it's a combination of sovereign funds on the one side and the regulator or the public authorities on the other side. And I think there are separate roles. And the goal or the challenge is to really create an attractive ecosystem where talent wants to come to, where talent has the opportunity to thrive, to further develop, and to set up successful companies. So I think this is really important. Sovereign wealth funds on the one side can be a source of capital and create provide the capital what's needed, to speak very generally. And the public authorities on the other side can make a lot of things in order to make it very attractive that talent comes. So, for example, stock option or taxing, ESOPs, employee ownership plans is one thing, or also helping companies larger companies to become clients of startups in order that startups and technology companies have the opportunity to generate revenues much earlier. So there could be, for example, tax incentives for larger corporations which deploy or which use the technology of startups. And also looking at bureaucracy, I mean, Europe is well known for its well-established bureaucracy. I think being a little bit more loose at that end, creating, for example, sandboxes for startups and technology companies which are in the development phase. This is certainly a very important thing. So again, providing capital on the one side from the sovereign wealth funds, and on the other side the public authorities playing in concert with the sovereign wealth funds to really develop a venture capital ecosystem which attracts talent, which creates a capital market, and which also allows startups, smaller companies to develop and not being buried by too much bureaucracy.
We were talking backstage before we came on about KfW. Is that the vision behind why that was created, the KfW Capital Fund?
Yes, I mean, KfW Capital was created as a subsidiary of KfW Banking Group, which is the world's largest development bank owned by the German government. So we are a wholly owned subsidiary of this development bank. The intention was to foster the development of the venture capital ecosystem of innovation in Germany and in Europe. So our investment activities are international. We not only invest into Europe, into German funds, we invest into European funds. We also do direct investments into later stage companies, and we do a lot of activities in order to foster the development of the venture capital ecosystem. So, for example, we have set up a KfW Capital VC Academy. We have KfW Capital Awards, the best female investor, for example, or the best impact investor, or the venture capital game changer, which we put out every year in order to draw public attention onto things which are urgently needed. Or another thing which we have developed from very early on, we've developed an ESG framework in order to assess the risks in ESG, especially tailored to the needs of the venture capital ecosystem. And this reporting framework has become a standard now in Europe, and all of our funds, we are invested in roughly 140 funds, complied with this. With those reporting standards. So this is quite promising, and we can see there are a lot of things we can do to further develop the venture capital ecosystem besides investing. And so to your question, yes, that was the intention of the German government, not only to provide capital, but also to do a couple of things around which help the further development of the venture capital ecosystem. And this is also because we, in Germany and in Europe, we have a lot of research and development institutes, a lot of IP, intellectual property, which is being developed also by taxpayers' money, because the universities and the research and development institutes, they get a lot of funding from the German state in the very early stages. And the idea really was to, that the translation from IP into company that it's being more successful. I think we have a lot of great engineers and researchers and development in Germany and Europe, but we are still lacking entrepreneurial talent.
So, what has been, from KfW's perspective, what have been your biggest lessons in aligning public objectives with private sector speed and performance? Where do these worlds kind of clash?
Well, the performance of the private sector, I think when there are a couple of things which need to be further developed in order to have a successful venture capital ecosystem. I already talked about reduction of bureaucracy, which is a very important thing in order to give freedom to develop. I talked about the attraction of capital and talent. Talent is one side, but capital is the other side of the equation, and we need really liquid, functioning capital markets. And if we look at the venture capital ecosystem or the tech capital ecosystem, at least in Europe, one of the challenges is it's not a liquid market. So an investor who invests into a fund or into a tech company which is not listed by definition usually is stuck with his investment for, if it's a fund, it's more than 10 years. If it's a startup, it's 7, 8 and even longer. So we really need to create functioning capital markets. We need secondary funds which take up the investment opportunities which are there. Because of if an investor in advance knows that he doesn't have an exit opportunity, they do not invest into the asset class. So mobilizing private sector capital is important, and mobilizing private sector capital means we need to create a secondary market. Another thing which is very important is we need more transparency in the market. I mean, there is no such thing as a Bloomberg in venture capital. So if you're an institutional investor and you want to get exposure to the asset class, it's actually quite difficult to get exposure because I mean you don't know where to start. It's if you want to invest into funds, I mean the funds have a lot of funny names. You don't know anything about their performance, and so you need to build up a pretty specialized team as an institutional investor to scan the market and identify the investment opportunities, be it on the fund side or be it on the tech side. And as the lot sizes of the investments are pretty small on venture compared to later stage private equity, for example, many of the institutional investors don't do that. So this is also very important. And I think besides liquidity, transparency, we also need to work on the trust side. I mean, investing into an asset, I mean, it's a long-term commitment. You also need to have trust. And that's important that especially founders and people in the venture capital arena, that they stick to what they promise to their investors, that they don't overpromise and underdeliver. This is something we, from time to time, observe in the market. This is certainly something which needs to be addressed.
I know, and we touched on it a few minutes ago, but I want to ask, you know, with rising interest rates, geopolitical concerns, what is your outlook if you're looking ahead? How do these things, politics in Germany and the rest of Europe, how do these affect the market and companies being able to get capital and grow and thrive in Europe?
You mean looking really 5 years ahead and how?
Yeah, I mean, with everything that's happening in Europe right now and globally, what is your outlook? What do you think that the market's going to look like? What do you think the opportunity is going to look like? I mean, with technology too. I mean, we could talk about AI. We could talk about all these changes.
Yeah. I mean, as a European, I'm optimistic for the development. I see a lot of challenges we are facing in Europe, but in general, I think every region should build on its strengths. So, speaking about sectors in Germany and in Europe, we have a lot of B2B SaaS companies, for example, which are where there's a lot of talent and IP. We have in Europe a lot of research and development on the life science and health side. So this is also a sector where there's a lot of intellectual property being developed. And also, I think Europe and Germany especially worldwide leading when it comes to climate tech and environmental technology. So this is something which is where I think there are strengths. And looking into the future, I think building on these strengths could be an important thing. And this is where Germany and Europe can prosper and further develop. But there are certainly other challenges which we're facing. We have no unified capital market. That is certainly something which is needed in order to have capital flows between the countries, but also capital flows into the European Union. So creating a capital markets union is a project which has been discussed for years in Europe, but I think it's the prerequisite to provide funding, especially later stage funding, to create exit markets for investments and to make the tech and venture capital market more accessible for international capital. I think this is a very important prerequisite.
So we've got about 2 minutes left, and I want to ask you a question that's not related to any of this. So we've got a lot of entrepreneurs out here in the audience, I'm going to guess. What do you think the opportunity for them is? What segment, what technology, where do you see the opportunity in investment and in growth? Like if you took the crystal ball and said, and we were talking about our sons who were in finance, right, before, where is that opportunity?
Yeah, I think that very much depends on what kind of investors are sitting in front of us. If there are investors like pension funds or insurance companies, so large institutional investors, I would say a huge opportunity is investing or getting exposure via fund of funds into the venture capital arena, because this is a means to, or the fund of funds are products which which are managed by professionals, which give you access to an asset class which is hard to access because of the intransparency. And so this is something which is important. If you are talking about sectors, as I said before, I would very much in Europe look into the health tech or life science sector. I would look into the B2B and SaaS sector. And also on the climate tech side, I think there are a lot of opportunities. And thirdly speaking, I mean, if we compare Europe to other parts of the world, we are lacking secondary funds. So investing on the secondary side, I think is a very attractive opportunity, because you really can select assets which have already matured, where the J curve is has already performed, and you can really see what you're investing in. And as we are lacking secondary funds, and as we need them in order to create a functioning market, I think there is a need for that. And so those would be 3 areas I would say please keep an eye on.
Jörg, thank you.
Thanks, Red.